Thanks for joining David, Kevin, and myself for the market update for the month of May. After a real challenging April, May really took off and gave us an excellent result. The S&P 500 was up actually 6.15% for the month of May. The Canadian stock market, as measured by the S&P TSX, rose 5.37%. And the Asian and the European market were also up solid single-digit positive returns for the month of May. I'm going to pass you over to the guys. They're going to dig in a little deeper about the things that happened. But as always, if you have any questions, don't hesitate to give us a call. Thanks. Take care. Bye-bye.
Canada's annual inflation figure dropped to 1.7% in April, down from 2.3% in March, which was great to see. Now, a big part of that drop was Canada eliminating the carbon tax. And as we've all seen, prices at the pump dropped by over 18% in the month of April, which was fantastic for all of us, even though oil prices did increase on the month. The overall report, though, was a bit underwhelming, with core inflation CPI, which does exclude more volatile items like energy and food, did increase slightly on the month, showing that even though energy prices are dropping, there are still some underlying inflationary pressures that are persisting. Retail sales were positive by 0.8% on the month, marking their first positive month of 2025. The report also showed that Canada's overall GDP is growing at a rate of 2.2%, far exceeding expectations by many economists. The bond market was originally anticipating that the Bank of Canada could cut interest rates at its next meeting on June the 4th, but after reviewing the most recent data showing that core inflation CPI is ticking up slightly, and the fact that our economy is hanging in there pretty well at this point, even though unemployment has ticked up to 6.9%, they're now anticipating that the Bank of Canada will likely hold interest rates where they are. Now, moving forward throughout the year, if our economy stumbles slightly amid trade tensions or unemployment continues to tick up higher than it is, we may see them decrease rates at that point.
There was lots happening in the U.S. as far as news goes in May as well. In the United States, Moody's, which is one of the large credit ratings globally, downgraded U.S. debt from its highest possible rating of AAA to its second highest rating of AA1. So again, many other credit rating agencies had already done this, but it is a decent deal as Treasury yields did surge in wake of this news. Now, the U.S. Government is still very, very unlikely to default on any debt. It's still very high grade rated, but that ratings downgrade was newsworthy. It sent Treasury yields higher, and it dampened demand when the U.S. Treasury sold new bonds recently in April. There was less demand for it, less appetite for that credit based on a slight downgrade to U.S. debt. The other big news we had out of the United States last month was the passing of Trump's one big beautiful tax bill, as he dubs it, in the U.S. House of Representatives. It was tensely negotiated. It was voted on several times before it eventually got enough votes to pass, and now it's before the Senate, who will confirm it, I believe, in early July. Now, one article or section of the Tax Act is Section 889, which is particularly of note to international investors, Canadians, who may hold U.S. investments. Section 889 dictates that the U.S. may impose higher withholding tax rates on U.S. earned investment income if it is deemed that entities, so corporations or individuals hailing from a foreign country like Canada, invest in the United States if that foreign nation imposes discriminatory trade practices against the U.S. And so one of those discriminatory trade practices that the U.S. is going after or highlighting is, for instance, the digital service tax. So Canada is a nation that imposes that, along with some European countries where a tax is charged against domestic and foreign corporations who benefit from marketing to Canadian browsers of the internet, right? So if you're on YouTube or Facebook, Facebook and Google have to pay a 3% tax to the Canadian government for the benefit of being able to advertise to Canadians who are on the web. And this is viewed by Trump as a discriminatory trade practice because overwhelmingly it is charging, a tax against large U.S. corporations for the most part. So this is sort of another thing that may be negotiated in upcoming trade talks between Canada and the U.S. So we're not exactly sure if Canada will actually be impacted by this, but withholding tax rates on U.S. earned income could go up significantly over the next 7 years if Canada happens to be one of the countries that is caught up in this. So that's something that we'll continue to have to monitor, and it may warrant portfolio changes slightly in the future if it does in fact come to pass. But again, the Senate has to vote on it and pass it as well later this month.
Global trade and tariff policy continues to drive market sentiment at the moment. The newly coined taco theory, or the notion that Trump always chickens out, seems to be the common view between most strategists and investors at this time. And we saw the most recent example of that as Trump paused his 50% tariff on the EU, pending further negotiations with them. Now, if Trump continues to talk tough, but in reality walk back most of the trade or tariffs that he's imposed, the market should continue to do okay. But if the beginning of July comes and no real outcomes have stemmed from the negotiations on a lot of these tariff talks, and he does implement the tariffs that he paused in early April, then we'll continue to see market volatility as we did in April. But the important thing for most investors is to remain calm. We can ride through this, and that we just need to be patient as we wait to see what ultimately comes from the tariff negotiations.
Yeah, it's likely to be continue to be a bumpy ride throughout the rest of the year. But our theory is that free trade is beneficial for all nations, as most people would agree. Massive tariffs are kind of like mutually assured destruction. So while Trump may talk about that and try and talk tough about imposing these tariffs, the reality is it's going to harm the U.S. too. And so ultimately, we don't think that many of those punitive tariff rates at 50%, 100%, or anything like that are going to come to pass. There may be tariffs, but we think that they're likely to be much more baseline figures like 5-10%, and or they're going to impact other nitty-gritty trade details, kind of like that Section 889 article that we just talked about. So there's a lot still up in the air, as there always is with investing. I think the main thing is to just recognize that all client portfolios are very well diversified. Yes, there will be ups and downs, but much like many markets before, we'll be able to get through this period of uncertainty just fine. And eventually, when things settle down from a trade perspective, the market will be in a position to have a nice rally once again.
But as always, if you do have any questions about the economy or your portfolios, give Harry, David, or myself a call anytime.